This week has been all about a global trade and geopolitical turmoil, roiling not just stock markets but compelling a rethink of defense budgets, relook at monetary perspectives, and recalibration of trade and investment dials. Even to some extent, business models are being reviewed. For example, the familiar just-in-time paradigm is now yielding to a different just-in-case structure and flexibility as businesses stay closer to their customers and context than ever before. Sticky inflation and higher borrowing costs are also driving a new quest for zero waste and resource efficiency. Hello, welcome to Global Business Insights, where we feature seasoned professionals analyzing the main business stories. But first, some headlines. In Wall Street, stocks tumbled again yesterday with equities unable to shake off a 3-week market sell-off despite cooler inflation data that came in as new tariff threats continued to weigh on sentiment. The latest salvo in the trade war is the US threatening 200% retaliatory tariffs on alcohol imports from the European Union if the bloc imposes higher duties on US whiskey. Some European producers are already warning that the alcohol tariff would be devastating, and not to forget, reciprocal tariffs can also be expected next month. Similar to the trend with headline consumer price index, that's CPI inflation in the US, the wholesale inflation or producer price index rose 3.2% on a yearly basis in February, lower than the 3.7% increase recorded in January and below market expectations of 3.3%. The annual core PPI rose 3.4% in the same period, down from 3.8% in January. On a monthly basis, the PPI was unchanged, while the core PPI declined by 0.1%. But analysts are nervous that the data that we got, that was yesterday, is yet to reflect the impact of higher import tariffs. More US data. Yesterday, the number of Americans filing new applications for unemployment benefits fell last week. But sharp government spending cuts and an escalating trade war could still be threats to labor market stability. The Labor Department yesterday said initial claims for state unemployment benefits slipped by 2,000 to 220,000 for the week ended March 8. Less than forecasts. U.S. Treasury Secretary Scott Bessent yesterday repeated assurances that the administration is more focused on the long-term health of the economy and markets and not short-term gyrations. He predicted that both the real economy and markets would prosper over time. Citigroup's head of technology, Tim Ryan, said the bank now aims to cut back external contractors to 20% of IT staff from 50%. And after this recent fraud event, the bank is adding 2,000 full-time IT employees to reach a headcount of about 50,000. A more technology-driven future comes with new threats for controls, cyber attacks, and risks requiring a different skill mix and more cautious use of contract staff. Renaissance Africa Energy Holdings yesterday announced the successful completion of its landmark acquisition of onshore operations of Shell in Nigeria. That is Shell Petroleum Development Company of Nigeria for $2.4 billion. Shell's announcement of a $5 billion Bongano Deep offshore field final investment decision late last year is, however, a sign that Nigeria still remains an attractive destination for the global oil major, especially for offshore upstream, which is seen as easier to operate. These acquisitions should lead to more capital inflows to the sector as authorities continue to address the need for comprehensively de-risking the operating environment, making them easier to do business in, reducing bureaucracy, hurting the supply chain, and helping operators achieve lower cost of operations in a far more competitive oil and gas space, increasingly facing many headwinds, including lower oil prices and transition to non-fossil fuel alternatives. Also in Nigeria, the House of Representatives passed the long-debated tax reform bills, adding that value-added tax of 7.5% will remain unchanged. While inheritance funds cannot be taxed, the sharing formula is for 50% to be distributed equally, 20% to be distributed based on population, and 30% to be distributed based on consumption. Mr. Taiwo Oyedele, Chairman, Presidential Fiscal Policy and Tax Reforms Committee, in a post confirmed that the tax reform bills were passed following the presentation by its Finance Committee and after the recent public hearing to obtain submissions from stakeholders. This week was one in which the global economy was being jolted by unclear, haphazard policy shifts on the world's largest economy. But there are other underlying issues in a world going through flux. These are a few of some of these issues. First, we have had a post-COVID human capital rethink with values, aspirations, and lifestyle goals, especially of younger people, radically changing. The models required to motivate staff are also radically different, requiring people management models that require a little bit more creativity than we've seen in the past. Second is a widening global wealth and quality of life inequality, a widening gap between Wall Street and Main Street. Hyped up valuations, and developed countries are getting much more richer than poorer ones. Third, a digital AI revolution is creating new opportunities and also many new control risks and threats, with a huge infrastructure gap, putting less developed economies at a greater disadvantage. Also, the higher and stickier inflation and elevated cost of capital is leading to a revival of zero waste principles and more resource efficient models in both private and the public sector. Finally, a rising and more confident China and BRICS alliance is already forcing a rethink as far as investment and trade is concerned, amid what looks like declining competitiveness in Europe and the United States. Like we said earlier in the week, there are threats but also opportunities, especially in emerging markets where the potential for growth remains very, very high. A lot of noise, no doubt, but the more savvy will be seeing through the chaos to find the signals and proactively taking action to their advantage. Also, a different, more technology-driven normal is slowly emerging, and we are likely to see more radical socio-political transitions driven by dissatisfaction with the status quo, especially in Africa and emerging economies. The Nigerian Economic Summit Group, NESG, has raised its own concerns over the ongoing trade war between the United States and China. They are alerting of the need for proactive measures to mitigate its impact. The NESG warning that Nigeria's import-dependent industrial sector is vulnerable to global trade disruptions, adding that Nigeria needs to divert some of its trade patterns towards countries unaffected by the US tariffs. Earlier in the week, we also got insights from the chairman of the NESG, Mr. Ni Yusuf, on what businesses can do to thrive in times of flux as we find ourselves in.
And so the first thing really is just stay close to your customer, hug your customers, understand their situation, understand their concerns, understand the challenges they are facing, and that gives you insight so that you can then forecast what that means for your own business. And as you're staying close to your customer, you also need to go and stay close to your partners, your trade partners, your distributors, your suppliers. This is the time when you need just create strategic relationships with them so that they can flex their schedule with you, so that they can support you to really withstand the pressures that will come this year. And talking about pressure, there will be currency pressure. So it's the time you want to, this year is when you want to see if you can do a lot of local costs as opposed to foreign currency costs, and also a lot of variable costs as opposed to fixed costs. So how can you variabilize your costs, whether it's your labor costs, your production costs, your input costs, your technology costs, even your warehousing, your supply chain costs? How can you turn them into variables and less of fixed costs? That is important for you to do this year. And this year will be a time for more of just in case and less of just in time manufacturing. So JIT won't work because you're not sure of when there will be disruptions, and there will be disruptions based on uncertainty. And so it's going to be more of a just in case. So you build a bit of reserves, you build a bit of stock to avoid situation of stock out that can impair your production. I'm talking about buffer. You also need to have cash buffers. Liquidity is important, and liquidity will be king this year. So have cash buffers that can allow you to respond to challenges, but also to seize unexpected opportunities. Many companies will need to sell assets, will need to even shut down. And so this is a period where you really want to work and see how you can use your cash to take advantages of these opportunities. Risk management is important. Compliance is also important. And so the US has waived the FCPA, that's the Foreign Corrupt Practices Act. But that doesn't mean other countries have. I mean, the UK Bribery Act is still operational. In Nigeria, the EFCC or the ICPC Act are still operational. And so you've got to understand the lay of the land. And so you need to have capabilities to watch risks, monitor trends, look at compliance, and ensure your company is compliant with the relevant laws, both local and in other markets where you play. And talking about other markets, geodiversity is important. You got to diversify your capabilities, be it production, be it input sourcing, be it even where you have factories or where you source from or where you hire people from. You got to hire from different geography. As you supply to the north, you must supply to the south. As you buy from the west, you must also buy from the east. So geodiversity is important to avoid concentration risk. Your inbound supply chain, your outbound supply chain should not be overtly concentrated on one source. So as you ship through land, you must ship through sea, you must ship through the air. As you transport through rail, you must transport through roads, etc. So your inbound and outbound logistics, your sources, your warehouses, they all should be diversified so that you are not concentrated in one area. Hope is not the strategy. So while we hope for the best, we must prepare for the worst, and that's the story of this year. You must embrace the uncertainty. You must prepare for the worst that can come. You know, the military talk about VUCA, volatility, uncertainty, complexity, and ambiguity. That's what will happen this year. So you must prepare for all those and look at different scenarios that will then ensure that whatever happens, you're able to thrive. And that means you must follow the data. You must follow the data. You must have management systems in place with both leading and lagging indicators so that you can get a sense of what is about to come. You can get a sense of what is likely to come. And you can then act and take decisions take informed decisions based on the data that's available to you. So you manage your business based on data, not based on emotions or based on feelings. And you must consistently communicate. And I would say even over communicate with your staff, with your suppliers, so that they understand what you're taking, decisions that you're taking. You know, the mission remains the same, but your tactics this year, your initiatives this year must be flexible and must change based on the dynamics of the situation.
Just out, the UK economy shrank by 0.1% in January thanks to slowdown in manufacturing. In Germany, the February inflation rate remained unchanged at 2.3%. Consumer prices also rose 0.4% compared to the previous month. JPMorgan analysts have said US equity market correction appears to be more driven by equity hedge fund position adjustments and less by reassessment of US recession risks, also noting that they don't see credit markets pricing a recession. Wells Fargo, head of equity strategy, also said that the tariff noise will pass. Asia-Pacific markets traded mixed today after all three major benchmarks in the US fell. US futures were positive. European markets also set to open higher. Do have a great weekend. Thanks for watching. Bye-bye.